What's up, everybody? It's Jonathan, and today we're going to talk about unusual options activity. Yesterday I had a question about Lending Club. Here's the screenshot from yesterday. Price $4.41. The question was about this 20,000 options that traded. Actually, 20,000 options traded on the 3.5 strike, 20,000 options traded on the 3 strike. And the client was asking, Jonathan, how do we interpret this information? So let's go over it. Let's learn. Learning unusual options activity is one of the most important lessons for an options trader. It translates into position management. It translates into understanding your different synthetics. We'll talk about synthetics on another video. So let's talk about this order right here. Go down on the bottom, we see time and sales. 11,700 by 11,700. So we could assume that's pretty much the entire order, right? Yeah, they did about 8,000 more, but I'm sure it's the same customer. They did the trade at 9:10 in the morning. January 3.5 puts, January 3 puts. So right away, I know that the spread that they're doing is a dime. If they do a debit spread, buying the 3.5s and selling the 3s, it's a debit, they're buying for a dime. If they sell for 3.5 and buy for 3, it's a credit, they're getting credited a dime. So even though it looks like, wow, 20,000, let's remember that it's just a dime, right? It's $20,000 of risk, which maybe to you and me, that sounds like a lot of money, but to an institution, to a hedge fund, to an endowment, I mean, it's a rounding error. So right away, we know it's really not that big of an order, even though it seems like a big order. But more importantly, let's try to interpret exactly what this is. What I do is now is a time where you want to look at price action. Now, I'm not real big into trading off price action. I think it was a really, really strong strategy in the 1930s and 1940s. But these days, trading off price action, not really a practical approach. But for unusual options activity, it is. If we look at Lending Club from yesterday, we're just looking on a 1-minute chart. At 9:10, you can see the stock sold off. This is very, very telling because this is going to tell me which way the market makers are hedging. Because if the customer bought the put spread, they bought the 3.5s and sold the 3s, that means the market makers sold it to them. The ones who sold the credit spread are getting long deltas. They're getting long stock. Market makers don't want to speculate on the direction of Lending Club. They really could care less. But what they do want to do is trade volatility. So the customer bought these. The market makers sold them. The market makers got long deltas. And in order to hedge their deltas, they sold stock in Lending Club. So that's exactly what the order was. So now I have you on present day. Lending Club, that was yesterday before, right? It was 50,000 by 50,000 on the open interest. Well, look at the open interest now. It's down to 34,000 and 7,000. So yesterday, when we looked at that order, we can definitively see that that customer was buying that spread. I guess that means now is that customer was short the spread. They're buying it back to cover. And we know they're buying it back to cover because the open interest, it was 50,000 yesterday, 50,000 yesterday. And you can see when those orders went through, they were covering those trades. So if the order was an initiation of a debit spread on Lending Club, buying the 3.5s, buying the 3s, that customer would be bearish the stock, bullish volatility. But it wasn't. All they were doing was they had a credit spread already and they were buying it back. This order means absolutely nothing. I would ignore it, but that's where you want to get to. You want to be able to interpret exactly what those institutions are doing. They're too powerful. You need to know they control the market. Additional questions, guys? Leave it in the comment section below. I'll answer each one of those. Thanks a lot. Jonathan Rose, Active Day Trader.